Welcome to Retirement. Are you on the right road? My name is Marnie Nesher, President of the Business Journal News Network. This webinar is being presented by the Business Journal News Network and Blue Ocean Strategic Capital. This presentation will be available online after the program. Give us a little bit of time and we will email the link directly to you. Please feel free to ask questions at any time using the chat function. Please let me introduce you right now to Ted Sarenski. He is the President and CEO of Blue Ocean Strategic Capital. Ted is recognized locally and nationally as an expert providing financial planning advice. He currently appears on WSTM3, Syracuse's NBC affiliate, taking viewers' calls and offering planning concepts to viewers. Ted appeared on the PBS affiliate in Syracuse as a permanent guest host of the program Financial Fitness, which aired live for 1 half hour every Thursday at 8 p.m. Ted has numerous awards, and I don't have time because we want to get straight to his presentation. So please let me introduce to you Ted Sarenski.
Thank you, Marty. Appreciate the invitation. Introduction, I should say. Good afternoon, everyone, and welcome to Retirement. What we want to do is get you from this to this in this presentation. So how do you get from growing up and working to enjoying your retirement, whatever it is you might want to do? One of the first things we like to talk about is that you really want 3 parts in retirement. And I use the 3-legged stool as an example. You'll have Social Security, and we'll talk about that it will be there. Hopefully you have a retirement plan and you've been putting away and you have retirement plan savings. But the 3rd leg of the stool is after-tax savings. We want to make sure that you have after-tax savings as well as your retirement plan savings. And we'll go into that in a little while as to why that part of the stool is important as well. Talking about Social Security, it is a type of it's an annuity. It's a payment that you're going to receive throughout your lifetime, and it ends upon your death. So it is like an annuity. Current full retirement age, 66. Now that's going to go up for those people born 1955 to 1960. At that point, you have to be age 67 to get your full benefits. Now anyone, even when they turn it to age 67, can start at age 62. Now, if you start at age 62 and you're still working and want to collect Social Security, there is a limit as to how much you can earn and still collect your benefit. That limit is $15,760 here in 2016, and it's projected, and it just came out, and I don't have the exact figure, but it's 16,000 something for 2017. When you earn more than that and are collecting a benefit, you'd have to give back $1 of benefit for every $2 you earn over that limit. So there are some situations where you'd want to be collecting benefits, maybe paying them back. One of the good examples is you might have children that are under the age of 18 still going to school, and you are 62. You might still want to be doing that because they can get a benefit. Even though you're paying yours back, they can get a piece of a benefit too. Now this chart shows the ages that you have to be based on the years you were born, and what the payment would be if you started at age 62. So currently, people who start at age 62, full retirement age is 66, they're going to get 75% of what they would have got at 66. Those people born 1960 and after, they're only going to get 70% at age 62. So again, that will go down in terms of how much you're going to get of your full benefit if you start early. There's a lot of various issues with Social Security. So one of the things I do talk about is that when you're looking at Social Security and you go down to the Social Security office, you're not necessarily getting what would be advice for your particular situation. The people at Social Security, their systems are designed to give you the largest benefit you can possibly get the day you walk in. Getting the largest benefit you can possibly get the day you walk in is not necessarily what's best for you, or for, especially in a couple situation, it might not be what's best for the family. So a couple of things we want to talk about. Divorce issues. If you've been divorced for at least 2 years and you were married for at least 10 years, you can collect a benefit on your ex-spouse. Your ex-spouse collecting a benefit is not necessary. They have to be Social Security eligible, but in that situation of a divorce, you could get a benefit, especially if it's higher than your own benefit. You can get a benefit on your ex-spouse's work record. There are income taxes on benefits, and I've got a chart that will show that in a little bit. Spousal benefits. The law changed on this back in November of last year, November of 2015. So now, anyone going forward, anyone who was not 62 as of the end of last year, a spousal benefit can only be collected if the spouse whose benefit it's based on is collecting a benefit. So again, that spousal benefit used to be that you could get a spousal benefit at full retirement age. I could walk in the office and say, I want a spousal benefit only, not collect my own and let my own run. No longer can we do that. You have to, my own is going to run. If my spouse is not collecting a benefit, I can't get that spousal benefit. There are disability benefits under Social Security, and there are family benefits within that. So the disabled person gets a benefit, but so can the spouse or children of that disabled person, if the children are under age 18, get also a benefit for a family benefits. Survivor benefits, that can be the widow, it can be an ex-spouse, it can be dependent parents, it can be children, and survivor benefits of someone who has died are substantially higher than just that person's benefit. It can be a multiple. The way the formula works, it could be 300% of what that person was getting or would have gotten on the date that they died. This chart just shows when you have to pay tax on your Social Security. So let's look at a single person or head of household. If 1/2 of your Social Security benefit plus your other income equals $25,000 or more, you have to pay tax on 50% of your Social Security benefit. Gets added to your taxable income, you pay tax. If 1/2 of your Social Security benefit plus your other income exceeds $34,000 for that single or head of household person, 85% of your Social Security is taxable. Now, these numbers haven't changed since they were put into place in 1984. So one of the things that was intended at the time is that more people would be paying tax on their Social Security benefits. One of the planning ideas in retirement is that if I want to reduce what I'm going to have to take in and pay tax on with my Social Security, is maybe I want to not wait to 70 and a half to take my required minimum distributions from my pension plan. Maybe I want to start, if I'm retiring at 62, maybe I want to start taking those then, reducing my RMD later on, so that when I do start Social Security, I might not be paying tax on as much because my RMD will be lower later on. Now, one of the things I hope that each of you has, whether you're employed in a company, whether you're self-employed, is a pension plan. And what's the benefit of the pension plan? Putting money into a pension plan today saves you income tax today. You're not paying tax on the money you put into the pension plan. You're not paying federal or state income taxes on that money. So even if you're in the lowest tax bracket, if I put $1 into my pension plan, it only affects my net by 80 cents. So I'm not putting $1 for dollar in. I'm putting $1 in, and it's growing, but it's only costing me 80 cents out of my net check. And then when I take that money out in the future, then I'm going to have to pay taxes on it. The idea behind the idea of a pension plan is let me save taxes today, pay taxes tomorrow at a lower rate than I'm probably paying today when I'm earning a lot more money than I might be using when I retire. So again, what we're going to do with the pension plan is draw out over time, and we're going to go into how we can draw out later on. Retirement plans. What are the types of plans that are out there? There's a defined benefit plans. Defined benefit plans were the old pension plans that everyone's familiar with, that maybe our parents or grandparents had, where you retired from a company and you received a monthly amount for the rest of your life. Now, they're still available, and I recommend that if you're a small business and let's say you've just got a few employees, if you are defined benefit plans say that based on what I make, what do I need to have in my pension plan to give me a certain benefit when I retire. So younger people, people who are at low wages, they're not going to have as much put in as somebody who's older and has a higher wage. So small companies where, let's say, the owner is older and most of the employees are very young, and the difference is also in wages, that the older owner might have a high wage, where the people he or she is employing may be at a low wage. You'd have to put in for everybody, but the amount you put in for those younger, lower wage earners wouldn't necessarily be very much compared to what you're going to be able to put away for yourself. So there are situations today even where a small business owner may want a defined benefit plan. Defined contribution plans or cash balance plans, this is where you're putting your own money away. There may be a company match. There may be a company contribution. In small companies, you oftentimes use a what's called I drew a blank just now, in a match that you put in, a safe harbor match is what it's called. You put in a safe harbor match so that you, the owner, can put away more than you can. If you don't do a safe harbor in a small plan, then you are limited, the owner's limited to what they can put in by how much the rank and file, your employees, are putting in. If your employees are putting in 2%, the owner will be limited to 3% in terms of their salary. So by putting in a safe harbor, which is either 3% of everyone's pay or 4% to those who are contributing to the plan, then the owner can put in whatever they'd like to put in. The maximum amount, $18,500 this year, plus a $5,500 catch-up if you're 50 or over. The 401k plan, money purchase target plan. Now, that does incur costs because you have administrative costs of the 401k plan. You have investment costs. You have it does cost to have a 401k plan put into place. You have to have the document. You have to have 5,500 filings. So there's various things that need to be done. A SEP plan, a simplified employer plan, simplified employee pension, is doesn't have those filing requirements, but you must put in the same percentage that you're for the employees that you're putting in for yourself. So this is an employer plan where the employer pays, and you could put in up to 20% of your net income into a SEP plan, but you're also going to be putting away that same percentage into any of your employees in a separate account for each one of them, and they are fully vested immediately. With a 401k plan, the money that the employer puts in can be vested over a 6-year time period, so that if someone were to leave after 1 year or 2 years, they don't get that match money. In a SEP plan, they get that money right away. A simple IRA, there's lower limits for a simple IRA in a company, in a small company. A simple IRA limits are at $12,500. I think it's going up to $13,000. Again, here, there's no filing requirements with the government. The employee is vested immediately, but it's much easier to take care of in terms of when you put the money in, how much you're putting in. It's maybe the first step that someone might do if they've started their business and they don't have anything. You might start with a simple IRA, move to the SEP, and later on move to the 401k. Being able to put away more money. Simple IRA is good, especially if you can't. In a SEP plan I mentioned, you could put 20% of your net. Well, if you can't afford to put that away, that much money away in a pension plan, then maybe you want to start with a simple IRA where the limits are lower and about half of what you might be able to put in a SEP, and that way you're saving for retirement and you are saving for your employees as well, but it's a lower number that you can afford to put in. Now, even if you've got those pension plans, you can do an IRA or a Roth IRA. There are income limitations, how much you can earn to still put into a deductible IRA. Those are lower amounts, but in a Roth IRA, which you don't get a tax deduction today, but what you take out later on will never be taxed. So there are income limitations on that are higher than the deductible IRA, even if you are in one of the pension plans up above. So, and how much can you reasonably expect to contribute over the next 5 to 10 years? that is something we need to be taking a look at as we go forward. We're looking in low return environments. We've had low return environment for the last 2-3 years in both fixed income. Interest rates are very low, and in the stock market, returns in the markets from 2014, 2015, 2016 have been relatively low. So with low return environments, we have to save more in order to have the same amount of money when we go to retire. Now, after-tax savings. Why do I feel you should have after-tax savings? So let's determine that you're making money, you've put money into the pension plan, which will be taxed later on. And why do you want to have other monies? Why do you want to have monies in savings accounts and investment accounts that you've already paid tax on? Well, everyone should have an emergency fund. You know, what if something happens? What if you need a new roof on the home, or the furnace breaks down just as we're getting into fall and winter here? You want to avoid, why do we want to have the emergency fund? To avoid short-term borrowing. If I need that roof or I need that furnace and I've got to have it now because it's going to be pretty cold soon, I don't want to have to go out and get a borrow at the bank, or borrow through my credit union, or borrow against a credit card, which would be very high interest, to pay for that furnace. I want to have that emergency fund to be able to pay for that. It also says that I'm living within my means. If I don't have any money set aside, what am I doing with all my money? Am I just spending it, and I'm not really accounting for what I'm doing? I'm saving in my pension plan, but I'm not saving anything else. Maybe I'm spending too much. Maybe I should look at my budget and say, what do I have to do? I got to pay my mortgage. I got to pay my utility bill. I got to have food on the table, clothes to go to work. But how much discretionary money am I spending? Am I going to Starbucks every morning where I could make coffee at home? Simple things that you might be able to do to save a little more money. The other idea of after-tax savings, if I down the road and I want to use some of this money and it's been a long-term savings, I have capital gains tax rates, which are much lower than ordinary income tax rates. And I have flexibility in retirement. And we're going to talk about why that's important from a tax standpoint. Flexibility in retirement means that when I go to retire, and now I'm drawing from my savings, whether it be in a pension plan, talked about Social Security taxability, now I've got to draw money on my pension plan. That might put me in a high tax bracket already. But what if I had after-tax savings? Then maybe I don't draw as much from my pension plan, which is taxable. Maybe it keeps my Social Security from being taxable, and I use my after-tax savings for the supplement of what I need to live on. So if I've got this pool of after-tax savings, I can maybe keep my Social Security from being taxed, or I can keep my tax rate at a low rate, maybe a 15% tax rate throughout retirement. So it gives us that flexibility if you have after-tax savings. So how much after-tax savings should someone have? Now, recommended that we have emergency funds at least 6 months of your current regular expenses. That is more important before you retire, because if you were to lose your job or income in your business fluctuates and you don't make as much one year as you did the year before, you want those emergency funds equal to 6 to 9 months of current regular expenses. Now, the emergency fund after you retire, you probably could cut that down because you're not dependent on your salary anymore for your living costs. You're dependent on what you put away, your retirement savings, your after-tax savings. So that emergency fund may be 3 months worth rather than 6 to 9. Again, the 6 to 9 is I want to make sure I'm covered until I can find that new job. And it might take me 6 to 9 months to find that new job. We want enough cash to cover our monthly credit card bills, automobile purchases, home repairs, as much as we can do things without putting it on a credit card, without borrowing from the bank over time to be able to do these things. That saves us money. If you look at your credit card statement, they're required to put this on there now. If you look at your credit card bill, it says at the minimum amount, this is how long it's going to take you to pay your balance off. And it could be 15, 20 years. And then it'll have a box next to that that says, if you pay this amount, you'll pay it off within 3 years. And that amount, the minimum amount might be $35. The amount to pay it off in 3 years might be $100. So again, credit cards cost a lot of money, and the sooner you can pay debt off, the better. Remaining after-tax savings can be, again, put for the long term. And I mentioned before in terms of tax planning with the last bullet item. Now, again, how much after-tax savings do you need to have? There are retirement calculators out there you can use, but to just use a quick rule of thumb, let's take an example. Let's say you need $80,000 a year. in retirement. And we're going to ignore inflation. And Social Security is going to give you $2,250 a month at age 66. We do our planning out to age 95. And statistics say that a couple who are both 65 years old, that one of them will live into their 90s. Greater than half a chance, greater than 50% chance that a couple where two are 65 years old, that one of them will live into their 90s. So to say, well, that's not going to happen, it's happening more and more these days. We're seeing people, the longevity with medical advances, with medications, with how we've taken care of ourselves because of the knowledge that we have that, let's say, our parents and grandparents didn't have. So let's say in our example, you're currently 55. You have $340,000 already saved in the 401k plan. We're going to add 17.5 and 55. So we're going to, again, currently the number is 18.5. I didn't update this slide, I'm sorry. But that's $23,000 that you're going to continue putting in. And you're going to do that for 11 years. In this example, the person needs to be 66 years old. So I need $80,000 a year. I'm going to get $2,250 from Social Security. So let me subtract $27,000 from that 80. Now I'm going to be putting in $23,000 a year for 11 years into my pension. I'm not showing any growth here, so that wouldn't necessarily happen. But now let's say I've got $593,000 in there. I'm going to say that withdrawal rate of 4% is about all I can do if I want that to last the 30 years. So 4% of the almost $600,000 is the $23,720. So what do I still need annually to meet my cash flow needs? I need $29,280. If I multiply that by 25, which gives me a number that if I take 4% of that number, I get the $29,280. I've got to have $732,000 outside the pension plan. I've got $593 in the pension plan. I've got to have $732 outside the pension plan at a 4% withdrawal rate to make sure that this money lasts for my years from the time I retire to age 95. Now, again, I don't have inflation built in here. I don't have any earnings on the money built in either. So this number, again, this is just a quick calculator for you to use to say, am I on the right track? And, you know, I say after-tax savings, but you could add the $593 and the $732 and just say somewhere, some combination here, whether it's in my pension plan or outside my pension plan. In my example of the $80,000 minus the Social Security, that person's got to have a little over $13,000 or $1.3 million to have that lifestyle for the rest of their life. So again, add those two numbers together, the 593, the 732. Do this computation yourself, and the total of those two is whatever combination you've got of after-tax and pre-tax savings. That's what you've got to have if you want to have whatever lifestyle you put in the beginning number. So again, a quick rule of thumb to say, what do I need when I go to retire to make sure that I've got what I want when I retire? So again, that's the example of that, of what I just said. Now, what's a sustainable withdrawal rate? What happens? What affects how much I can take out of my funds? Well, we've got volatility. You know, if I retired in 2006 and then I went through 2007, 8, 9, where the stock market dropped over 50%, the bond market dropped also at the same time, not to the same extent, but that initially it dropped about 15%. Well, if I took a hit of that kind of money, that kind of hit to my savings at the point in time right after I retired, that's a problem. So volatility of markets is a problem. What's the optimal portfolio allocation? What could I have been in that would have helped mitigate that loss? And one of the theories there is that when I go to retire, the first couple years of retirement are very important. What happens in the first couple years might predicate what happens for the rest of my retirement years. So I want probably the least amount of risk possible in my portfolio at the time I retire. And as time goes on, the older I get, the more risk I can take, because now I've got less years to draw from it, and I don't have to worry that I'm going to run out of money if things are good in my first few years. So sensitivity to the date of retirement, mentioned that with, you know, if you retired in 2006, or somebody that retired in 1999 and then 2000, 2001, 2002, the stock market fell. How much changes in managed my risk? Fees and taxes. How much am I paying in fees, and how much am I paying in taxes on my portfolio? That affects what my withdrawal rate can be later on. So my Michael Kitts, as Director of Research at Pinnacle Advisory, had done a study. He used 30-year rolling time periods from 1868 to 1980. So he said, okay, if I retired in 1868, what happened between 1869 and 1899? If I retired in 1980, what happened between 1981 and 2011? So 30-year time period from that date, what happened? And it ranged from 4.3% at a low point to 10.7 at a high rate, averaging 6.6 over that 112-year period. So there was 112 30-year periods he looked at. So it's influenced by what you do in the beginning. As I mentioned, your early returns influences how you do for the rest of your retirement. Valuation environments, our stocks priced high when you retire, our stocks priced very low. What if I retired in 2008 after the market had fallen and I felt I had enough money? Well, the valuations of companies were very low at that point in time. Maybe I can take more out later on. Volatility necessitates a 2% reduction from historical averages. So he's saying that because an average of 6.6, I don't necessarily use 6.6. I might have to use less because there is volatility and I might be taking money out at a bad time. And taxes and fees associated with my withdrawals, associated with my investment costs, how I have my money invested, you have to reduce it by another 0.5. So he took the 6.6 and said that the base safe withdrawal rate is really 4 to 4.5%. That's what we start with. And there's been discussion since he did this study just back in 2011 that because we've had low return environments since 2011, that maybe even 4% is a little high because we're not earning much. I say it's still probably a decent rule of thumb only because inflation's been so low. Inflation's been down in the 1% area. So I'd say you're probably okay with that going on in terms of how much you're assuming that you are putting away. I forgot to mention this at the top too. If anybody has any questions, just send them in the chat area and I will answer them as we go along. But I will take questions at the end as well. Now, what he says though too is that that's your base rate. Now you have to adjust for a safe withdrawal rate based on, and he examined this and said based on PE ratios, price to earnings ratios of stocks in the U.S. stock market. So he said if your PE is above 20, if the price to earnings ratio in the U.S. stock market is above 20, use the base rate, the 4% rate, 4 to 4.5. That's where we are today. The market valuations on companies are pretty high right now. They are over 20. And that's not because we think companies are doing well, but more people have money in the stock market today because they're not earning any money in the fixed income market. If you can only get 1 or 2% in fixed income, but I can get 3% in a dividend, even if stocks go nowhere, I want to have it in that dividend-paying company. But because people are buying those companies, the prices of stocks have risen, and the PE now, because of the earnings of the company not changing much in the last few years, our PE is above that 20 right now. If you're between 12 and 20 at the time you go to retire, you could increase it by 0.5 point. And if it's below 12, let's say you did retire in 2008, and I think the PE ratios at that point in time were around 7 or 8, he's saying you could increase your rate of withdrawal to 5 to 5.5%. You could increase it by a whole percentage point. So again, that's kind of a rule of thumb. What your budgets are and what you feel comfortable with is, of course, up to each person. For tax planning, that's another way to make sure that our retirement years, or even our years today, I have more money if I take advantage of all the possible tax advantages that are out there, so that I'm not paying more tax than I have to. There is a new 3.8% Medicare tax surcharge on investment income. So now I've talked to everybody about having this after-tax savings, but if your modified adjusted gross income for a single person is over 200 or more, or married filing joint 250 or more, you pay a 3.8% Medicare surtax on that, on your investment income that exceeds those dollar amounts. Payroll tax for higher earners, 0.9% increase in Medicare on payroll tax. So if somebody's making over those amounts on their W-2, they pay an extra 0.9%. Self-employed people pay that as well. They pay it on their personal tax return. So what can we do in terms of tax planning to preserve more assets in our retirement years? Well, let's say you've had losses at the beginning part of the year, because the beginning part of this year, 2016, there were a lot of losses, and maybe you took advantage of that. Maybe you just wanted out of investments. You have some losses on your investments. Well, you can harvest gains. Harvesting gains is not. There's a 30-day wash rule affects losses. If I sell a stock or a mutual fund or anything today, and I have a loss on that sale, and I buy that same stock or same mutual fund back before 30 days is up, the government says I can't take advantage of that loss. I have to be out of it for 30 days in order to take that loss. So if I sold it today, which is the 10th of November, I'd have to wait until the 11th of December to buy it back to be able to take that loss. Gains aren't the same. I could have a gain if I sold that stock or that mutual fund today at a gain. I could buy it back tomorrow because the government says, fine, we would love to have you pay tax on that gain. So if I've got some losses that I've incurred earlier this year, I've got loss carry forwards, harvest gains before year end. And if you like that investment, buy it right back. Exercising stocks options, paying bonuses before year end. If you're employing people, pay the bonuses before year end. Get that tax deduction now rather than later. If you're working for a company, you have deferred comp elections, you need to make those now. And maybe that's a way. If it looks like I've got a lot of money left over at the end of the year, I'm saving it, I don't know where to invest it, well, maybe I should put it in my deferred comp so that I don't get paid tax on that currently. Roth conversions. Let's say you've had IRA accounts that you've been putting money into for quite a long time. You're self-employed, you have a bad year. Maybe your income's going to be less this year for another reason. Maybe you retired halfway through the year. Think about doing a Roth conversion and saying that I'm going to move money from an IRA account that is going to be taxable later on to a Roth IRA that will never be taxed. I do have to pay income tax today on that conversion, but maybe I'm going to pay it at a low tax rate. So taking a look at that. Income acceleration. If you're a cash basis taxpayer, get your billings and revenues into this year. Accrue bond interest on Series E bonds or other bonds you might hold. Accelerate installment payments. I sold a building. I sold my business. Maybe accelerate that into this year. This might be more important today, especially we've got that 15% tax rate and 25% tax rate. There's going to be tax reform. Which way is it going to go? We don't know. We can't predict that right now, but there probably will be tax reform, and very possibly taxes could go up for individuals as well as go down. Other planning ideas, you got qualified money, non-qualified money. So let's say you've got that after-tax pool of investments, you've got your pension plan, whatever plan it might be, which is pre-tax. You're going to pay money on that. You're going to pay tax money on that later. Maybe you want the fixed income kind of things in your pension plan that are paying interest. If I have that outside, I've got to pay tax on that interest. And maybe on the outside, I want to have my stock investments where I'm not going to pay tax until I sell that stock or that mutual fund. I'm going to pay tax on the dividends, but I'm not going to pay tax on any gains unless I actually sell it. So that way, I'm paying at capital gain rates. Even if I do sell it and I have a gain, I'm paying at capital gain rates rather than ordinary income tax rates. So looking at how you have your money allocated. Maybe I want, again, the fixed income investments in my pension plan, my stock investments outside. Your adjusted gross planning to stay away from the 3.8. I hope everyone on the call has that problem, that you're making $200,000, $250,000, and you got to worry about that part. Accelerating your itemized deductions, lumping them. Maybe the standard deduction is up pretty high these days on a joint tax return. It's $13,000, $14,000. Maybe I get there some years, I don't get there other years. Well, in the year I have maybe some larger interest or larger charitable deductions, and I'm going to be able to itemize. Let me put a lot into that year, and the next year maybe I don't have any of my charitable contributions, that I move them into the following year. So let me lump things into tax years so I can take advantage of that higher itemized deduction when I can. Evaluating your debt. Are you paying a lot of things where you're not getting a tax deduction? You've got credit card debt. You've got automobile loan debt. Do you have equity in your home? Getting a home equity loan, you can have a home equity loan of up to $100,000. They don't care what you spend the money on. It doesn't have to be on the home, but by accelerating or by having that home equity debt and paying off the credit card, paying off the automobile loan, I can deduct that debt. Or maybe I've been kind of lazy. I haven't refinanced my regular mortgage on my home. Mortgage rates are still hanging out at all-time lows. Maybe I should refinance my mortgage, and I could possibly lower the years I've got to pay on it with the same payment that I'm paying today, or I could lower the payment because I have a lower amount of mortgage in terms of the interest rate that I'm paying. Because again, interest rates on mortgages are at an all-time low. Be careful of the alternative minimum tax. If we do lump itemized deductions, we have a lot of exemptions, things of that nature. You might fall into the alternative minimum tax, which is still there and does affect people. And they say, well, that's really for high-income people. Not necessarily. I've seen the alternative minimum tax kick in as income as low as $50,000 to $75,000 because those folks had a lot of children or had some other things that they were deducting that for alternative minimum tax purposes aren't deductible. So don't think it only affects the high-income person. So if you're doing tax planning, watch out for that. Health insurance options. What happens if you want to retire before you're 65? At 65, still the age for Medicare, at 65 you become Medicare eligible and you qualify for Medicare. But what if you want to retire at 62? How do you cover yourself for health insurance? Well, there's COBRA, so you get 18 months. If I'm at a company that has health insurance, I can buy the health insurance through that company for 18 months. That's what COBRA is all about. Maybe I get a part-time job. Now, of course, I've got the Affordable Care Act. I've got health insurance nationally available. But as we've seen in the press recently, that's an expensive alternative as well because that does cost money. And if I don't buy the health insurance, I've got a penalty. And it's tough to not have health insurance, especially if you're 62 to 65. If you've got medications, you may be going to the doctor more often than you did when you were 40. So, this age group, you probably do want to make sure you have health insurance. Long-term care insurance. In Central New York, the average cost of full nursing home care is about $11,000 a month. Looking at $121,000 a year for caring for someone in a nursing home, full-time care. Just think of that and say, based on what I have, especially if you're just by yourself and you don't have any heirs and your money is just for you, you're not going to leave it to anybody in the end, maybe it doesn't matter. But if there's anyone involved, a spouse, children you care for that you want to have inherit money, you want to look at long-term care insurance and say, this is a way to protect my assets. And it's not cheap. It can be expensive, $3,000 to $5,000 a year potentially. It's all based on age and health, of course, just like any insurance, just like disability or life insurance, same kind of thing. But if you think, if I've got $500,000 and it costs me $5,000 a year for long-term care insurance, that's 1% of $500,000. For 1% of my total value, I can preserve that $500,000 for my spouse or my children or whoever I want it to. If I don't have it, that $500,000 is going to pay for 4 years of long-term care, and then it's all gone. Again, Medicare eligibility still at 65. How we die matters. If we're living longer, our health costs are going to be higher. The longer we live, we're going to have higher health costs. The things you need to budget for in health in the future is about $250,000. If you're at age 65, you're going to spend about $250,000 between insurance and co-pays and all that. People think when I go on Medicare, it's going to be cheap. It's not that much cheaper than the insurance you might be paying now. The Medicare costs, you don't pay for Part A, but for Part B, the new cost for this year coming up is about $140 a month. Then on top of that, you want a supplemental policy. That's $200 to $300 a month. You need Part D, the drug coverage. That's $30 a month. If you add all that up, we're looking at about $500 a month. And each person's individual. So at $500 a month, that's $6,000 I'm paying for insurance for a person. If I'm a couple, that's $12,000 a month just for the insurance. Doesn't count the co-pays, doesn't count the deductibles, doesn't count the other things you're going to pay. Because Medicare doesn't cover eye coverage, it doesn't have dental, you're still going to be paying out of pocket for those. So let's talk about Medicare. When you go on Medicare, when you do retire, and you are 65. When you're 65, you qualify for Medicare. And if you're working for a company that has 20 or more employees and you continue working, you can be on that plan still, even though you're 65 and over. They have to have your regular insurance. But once you leave there, you then have to sign up for Medicare within the first 6 months of you leaving that company. Now, let's say you go to 67, 68, you've been having the health insurance coverage by the company. COBRA does not count. So if I think, well, I can keep on COBRA for another 18 months, I don't have to sign up for Medicare. Medicare doesn't look at the COBRA. They just look at the time you stop working. So you'd have to sign up within 6 months for Medicare. Part A is hospitalization. If you qualify for Social Security, you qualify for Part A. Part B is the medical coverage. That's your doctors, your lab visits, things like that. Medicare Advantage is like a HMO or a PPO, a network of physicians that you sign up for. So you don't pay, you still have to pay for Part B. Most of them have you pay for Part B, but you don't have to pay for Part D, the prescription. You don't have to have a supplemental policy, but you are limited to the doctors within that group because that's how those work. So there are Medicare Advantage plans. If you have that, again, you wouldn't pay D, you wouldn't have the supplemental, but you're limited in terms of your region. If you don't travel a lot and you like the doctors that are in your region, that's a good thing. If you travel a lot and your physicians aren't in that Medicare Advantage group, then maybe that's not what you'd like to do. Prescription drug coverage, that is also something you pick up if you're not doing Part C. That does cover your medications. Of course, there's a hole in there. Now that's initial election and annual, October 15 to December 7. I want to look at that every year because what I want to look at when I'm buying Part D coverage, each company is similar in terms of what they're offering, except they're only required to have certain name drugs. They're required to have the generics, but Company A might have a non-generic drug that I'm taking, where Company B might not have that non-generic drug I'm taking. So I want to look at what drugs I'm taking, look at Part D plan and say, are my drugs covered under this Part D that I'm buying? So those are voluntary. You do pay for those. Those aren't supplemented by the government, where Part A is. Part A is actually paid for by that 1.45% of the 7.65 that comes out of your pay each month. Medical supplemental policies, if I'm doing Part D and D, I want to have a Medigap policy, because in Part B, the doctors, there's a deductible of about $216 each year, but I also pay 20% every time I go to the doctor, every time I have a lab test. Anytime I do one of those things, a 20% copay. My Medicare supplemental policy might pay that 20% copay each time. So if I've got allergies, I've got something where I'm constantly going to the doctor, I want to make sure I've got that supplemental policy to pay for that 20% every time. So you don't have to have one, but you probably want to have one to cover all those types of things. And there's A through N are now offered. No matter what company you go to, mentioned at the bottom, for foreign travel, C, D, F, G, M, and N all have foreign travel. Let's just pick Plan C. Plan C would be the same no matter what company you go to in terms of what it covers. The prices might be different, but what it covers would be the same from whatever insurance company you're going to obtain that Medicare supplemental policies. That's something that is confusing in terms of when you go to shop, because there are a lot of companies out there that offer these. So again, you want to see what kinds of things do each of these cover and what do I need. Now the new retirement. Now you may be downsized. My sister was her company decided to go out of business basically, and everyone went their separate ways. She was in her early 60s at the time. She was forced to downsize. They say there's no age discrimination, but it's hard for a 61, 62-year-old to get a job when the employer knows, well, you're not going to be here a long time. I might really want to hire that 25-year-old or 30-year-old rather than you. They're not going to say that as their reason, but it's not easy to get a job. So you've got that. You may be in a job where you physically just can't do it anymore. I'm a plumber. I just physically can't go under a sink anymore. I can't do it. I physically can't do it. So you need to make that. So you've got that forced. So you might have an early withdrawal. What do you do with life insurance? You might have equity in your residence, home equity loans that you could take out. There are some ways to try to get there. If you've got this problem, you probably do need to talk to somebody about, well, what do I do, and how do I best ease into retirement here when I'm forced out. But let's say it's retirement by design. You just decide, I want to no longer work. What am I going to do? You've got health insurance that you have to be concerned about. Where are you going to live? Are you going to continue living here in Central New York? Are you going to move to North Carolina? Are you going to move to Florida? Are you going to move to Mexico? You know, where you live will determine, you know, what the cost of retirement is going to be for you. Do I think about Roth conversions? If I stop working and I don't have any income coming in, I haven't started Social Security, maybe I want to convert from what was a deductible IRA or my pension plan to a Roth conversion, because I have no other income and I'll pay a very low tax rate in those first couple years of retirement. I have inherited IRAs from parents or uncles and aunts. Spousal rollovers. My spouse and I have a option where I can, if my spouse dies, I can roll her amount into my IRA. If I die, she can roll my amount into her IRA. That's not available to people outside of spouses. Outside of spouses, if somebody inherits an IRA, it's inherited and they must start taking distributions. When I'm 70 and a half, I must start taking from my pension plans, even if I don't need the money, but because the government says that's the rule. 70 and a half, I must start taking out and do something with that because the government wants some tax money. They don't want this going on forever. What am I going to do in retirement? Now, I talked to a lot of people about retirement. They say, I want to retire. I want to get out when I'm this age. Have you thought about what are you going to do when you're no longer working? I don't want to work anymore. Yeah, but what are you going to do? Do you have hobbies? Are you going to continue working? Are you going to volunteer for organizations? Maybe I'm doing what I do, but later on I want to teach. I want to mentor. Maybe I just want to sit on the beach and relax. I don't want to do anything. But it's good to have an idea of what you want to do in retirement, because what you want to do is going to determine how much you're going to need, which is going to determine how much you have to put away prior to retirement. So you don't want to wait till just a couple years before retirement to say, this is what I'm going to do after I'm done with my current position. You want to have an idea of what you want to do a long time before that. So start thinking about those things. I don't know what ages we got on the phone call today, but start thinking about what is it I want to do when I'm no longer working, and have that idea. And one of the biggest things, if you are married or in a relationship of any kind, what does the other person want to do? I've met with a lot of people that when I've asked that question, what are you going to do in retirement? They've got the couple has two totally different ideas of what retirement looks like. And now there's a conflict because they've never talked about it. They've never said to their spouse or significant other, well, this is what I want to do. And the other one looks at them like, really? I never knew that. Because I want to read books. And the other one wants to go hiking across the United States. We've got a problem that they need to work out. And so that's another thing. What about the people in your life? What do they want you to, do they want you to be around? Maybe it's children or grandchildren. Do you want to be near the children or grandchildren? What does retirement look like? And especially if you're in a relationship, talk to the other person about it. So there's a lot of things we covered today. And the whole idea of this talk was to say, we've got to think about these things. And why do we need to think about these things? Because you want your retirement to end up looking like this, and you don't want your retirement to end up looking like this. So if anybody has any questions at this time, again, chat's open. I haven't seen anything yet, but I'll stick around for a few minutes. I think we've got maybe 5 minutes left if anybody has a question or wants to throw something out there to the group, just put it in the chat. We'll get that answered. Other than that, I appreciate everyone attending today who did. Thank you for your time. And I hope that this helped a little bit in you looking at where your future is going to be.
Thank you, Ted. And thank everybody, all the attendees, for joining us today. Please remember, after, we will be sure to send the link. We will email it to you when it's available for download. And we'll make sure that we add in Ted's contact information for you as well. Thank you all, and have a great day.